At this time, I will hand over to Mr. Andray Francis, our CFO, who will be presenting on the financial highlights for the year 2023. Thank you.
Thank you very much, Mrs. Rowe, for that. They just want to welcome everybody to the call, and thanks for joining us. I'm particularly excited to present these financial results to you this year, coming off our 15th anniversary. I think we delivered a really strong performance led by our rental income, our core rental income. This year showing a 15% growth in our rental income up to $3.8 million, a record as our CEO has indicated. And the primary thing behind this is the growth in the asset portfolio, as we added the Grand Harbor shops in the pretty much the end of the third quarter of last year. And we've also improved the rental rates at our properties, both in Jamaica and in Cayman. Strong property management, improvement in the properties has pretty much ensured that we're able to easily get those improvements in rental rates that we have built in our contracts without any issues. So it's a continued growth in the portfolio, a continued improvement in the rates and improvement in our properties that is really driving the growth in our core rental income. And just to add the diversity of our business, it's apart from our core rental income, we've seen a growth in the total revenues for the company. So we had a 19% growth over last year in total revenue, up to $7 million. And so apart from the rental income, we've also had a significant capital gains where our fair value grew significantly during the period. And we've also had a significant gain on disposal of our assets. So we did dispose of a property that we had in the Dumfries Road last year, and we also exited the Miami portfolio in terms of the condos that we were holding last year. So we did recognize about just over $400,000 worth of gain on sale, and just about 2.6 million worth of fair value uplift on top of the revenue growth. So I want to highlight the us breaking that $1 billion barrier. I know we're a US dollar company, but I think it's important to share that we've broken that $1 billion barrier in terms of Jamaican dollar total revenue. And we did that coming right off our 15th, and I think that was a very good result for us in that year. So this, just to look at our core operating income, we have grown that by 25% over last year. And again, it's the strong rental income in conjunction with good management of our operating expenses. So operating expenses have pretty much grown just about 1/5 of the level of growth in our core revenue, and that has given us a really strong growth in our core operating income when we look at rental income versus our operating expenses, right? Just to put that in context, also we've in conjunction with that strong management of our operating expenditure, we've seen where our net operating income margin has grown from 57.3% last year up to 61.5% this year. And that's really a steady growth trend that we've been seeing over the last 5 to 6 years, where we have pretty much been able to grow our income base while keeping our cost under control. Right? This translates also into the bottom line, where our EBITDA and net profit have both seen significant growth, 23% and 22% growth, respectively, over last year. And this growth is coming from the increases in the core business, as well as the increase in our capital gains as we grow the asset portfolio. But it's also a bit of managing our finance costs. So even though our finance costs grew year over year, from about 482 to 681 this year, it still translates into a significant growth in our net profit, to 22%, as whilst we hold cash in terms of being able to take the opportunities as they come in the market. We ensure that we basically get as much of the investment income that we can out of those holding those cash, and so that in itself tends to reduce our net finance costs as an impact on net profit. So it's a strategic management of cash on hand, of our debt portfolio and our assets that will generate this level of net profit, right? And just to put that also in a little bit more context, when we look at our 5-year growth rate in terms of rental income, operating income, and net profit, we're seeing strong growth in those on an annual basis. Our rental income growing on average of about 18% per year, or net operating income growing on average of about 29% per year, and about 16% growth annually for our net profit. So these results are not flukes. They are pretty much the culture that we have developed here of creating value and using the assets that we have to generate value for investors, and we'll continue to do that. Another key metric that we like to look at, and is very important for investors, is our funds from operations. This is basically the real cash that's generated each year from the business. That has grown by 4%, and this growth is important because it's the basis on which we usually pay our dividends to our shareholders, or return that value to our shareholders. And so a key objective that management has is to grow this number year on year, and we have grown that by 4% this year. And when you will see that continues into ensuring that we have dividends remaining at a pretty high level going forward, right? Just to in terms of the dividend trend, we can see that this year and last year we've really broken that $1 million barrier, and intend to continue to grow dividends in that way. And it's a direct result of growing our FFO and keeping the funds from operation at a very high level. Okay. Now, just to look at our financial position in itself, we spoke about the growth, the acquisition of Grand Harbor to our portfolio. This has really driven a significant 20% growth in our asset under management at the end of 2023. We're now at $70 million. The aim is, as CEO will tell you, in the short term is to get to $100 million, and we're heading there nicely with a 26% growth this year. Apart from the acquisition of Grand Harbor, the asset values from the existing assets have also improved significantly this year. and that has helped to push our asset under management nicely for 2023. So when we look at our debt portfolio also, the debt portfolio has grown from 11 million last year to 22 million this year, particularly because we financed the Grand Harbor acquisition for during 2023, but we've also paid down some of the debts that we had existing, and we did refinance the last set of variable rate debt that we had to ensure a more predictable impact that the debt financing will have on our P&L, and so we're really proud about that strategy. But the growth in the debt stock is really a stepping stone for the growth in the business itself. And when you look at some of the key ratios, you'll see that we're still in a very conservative position, or loans to asset is just about 31% in 2023. Our loan as a percentage of investment property is at a moderate 38%, and our debt to equity is just about 46% at the end of the period. We like to compare that to our loan covenants as we look at how much capacity we have to leverage the business a bit further for growth. And right now our debt to equity, not target, but max limit is about 5-1, and our loan to value ratio is a max 70% based on what our debt covenants are saying. So you can see that we are basically in a position where we can access financing for the growth of the business even into next year, right? Some of that is that we're continuing to build intrinsic value in the company, and this year our equity has grown to $47.9 million, which is a 7% increase over last year. So we've grown the business through the net earnings for last year, net of the dividends that we continue to pay out, and this has really build that intrinsic value that the investors are looking for, and that we as management striving to deliver for our stakeholders. So all in all, I think this year was a really strong year for us, not just on your financial performance from your income statement, but also a strong financial position backed by a growth in our asset, and definitely translating into our equity base.